Hello and welcome to this session. This is Farhat, in which we will discuss the relationship between audit evidence and the risk associated with an audit. Now, when we are conducting financial statement audit, risk lies everywhere. We have risk everywhere. We have audit risk, inherent risk, control risk. So we need to know how to manage these risks. Why? Because we need to collect sufficient and appropriate audit evidence to support our opinion about the financial statement, taking into account the nature, timing, and extent of the evidence shaped by that risk, the risk that we assess, the risk that we need to understand in order to conduct what? The audit, the steps, collecting the evidence. Now, understanding how different audit risk influence the audit collection is important, is critical for audit professionals as well as accounting students and CPA exam candidate. And this is what we will discuss in this session. What's the relationship between the risks and audit evidence? So, knowing the audit risk model from prior session will be helpful. I will revisit the audit risk model as well in this session because I need to pick each risk separately, discuss it, and how does it relate to the evidence collected. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, farhatlectures.com.
Hello, my name is Farhat. You are here because you are either an accounting student, a finance student, or someone who's studying for their CMA or CPA exam. Great. You are looking for some additional help, and we can help you. I strongly encourage you to visit my website, farhatlectures.com. I offer additional lectures, resources, including PowerPoint slides, multiple choice questions, in some circumstances, exercises, and true-false questions. Our material is aligned with your CPA review courses, with your CMA review courses, with your college courses. I offer a risk-free trial that you can try to find out whether my website can help you or not. If you find it helpful, you subscribe, you keep your subscription. If not, you cancel and your risk is free. If you like this recording, if you like my lectures, you would like what's on the website, give me a chance to help you with your college courses as well as professional certification. I hope to see you on the website.
Let's start with a general question. Just asking you a general question. What happens when risk increases? If you are conducting an audit based on common knowledge and risk lies everywhere, the risk of material misstatement, the audit risk, the control risk, the inherent risk, whatever you know about all these risks from prior sessions, what do you think you need to do when you have more risk? Well, I hope you know, common sense will tell us if we are facing more risk, to be more confident about our opinion, we need to collect more evidence. So keep that relationship in mind. So more risk, more evidence. We have to do more work. Auditors' workload intensifies. They must gather more and higher quality evidence to reduce the chance of the undetected errors or misstatement. Why? Because we are dealing with a lot of risk. A lot of risk. How would you respond? You do more work. There's a saying that goes, the best antidote for anxiety is work, is action. Same thing for risk. Think of it this way. If you have risk, collect more evidence. If you have anxiety about something, tackle that something. Work on it to reduce the risk. And how would we respond as auditors? Well, we adjust the audit procedures so we can collect higher quality, more quality-based evidence. We can increase our sample size rather than selecting 15, select 25, increase the sample size, perform in-depth testing. And we'll talk about all of those later on when we talk about the steps. But what you need to know, more risk, more evidence collection. And it's common sense in my opinion, but we're going to dive deeper into specific type of risks. But to grasp fully how this works, it's essential to explore the specific types of audit risks. We don't have one type of audit risk, we have several that impact the evidence gathering process. And this is going to take us back to the audit risk model, which is inherent risk times control risk times detection risk. Let's review this. What is detection risk? Detection risk is the risk that the auditors fail to detect material misstatement. How do you find this? We solve for this. We rearrange the formula, detection risk, and we rearrange the formula equal to inherent risk times control risk over audit risk. How do we solve for it? Well, we'd say detection risk equal to, basically we divide both sides by the inherent times the control. What do we call this? RMM. Therefore, when we solve for this equal to audit risk divided by RMM. What's RMM? RMM is inherent risk and control risk. So this is how we solve for detection risk. The risk that the auditor fails to detect material misstatement. We fail to do so. Now, what is audit risk? Audit risk, this risk is set by the auditor. The auditor determines how much risk I want to take. Do I want to take 5, 10, or 15? Well, if the audit risk is set at 0, it means I want to take no chance. No chance in what? No chance in not finding the error, the acceptable level of risk that material misstatement might remain undetected. If I take 0 chance, it means I'm not taking any chances. And when you do so, you have to sample everything. That's not reasonable. I'm just telling you so you understand what does it mean 0%. If you said 5%, it means I want to be 95% confident. If you're taking 10% audit risk, it means you are comfortable with 90% confidence. Now, the lower this audit risk, the more work you have to do. Because if you want to be more confident, you're going to have to do more work. Inherent risk, the natural susceptibility of accounts to misstatement without considering control. This risk is assessed. And we talked about this risk in the prior session. It's assessed as either low, medium, or high. Now, high means you have risky inherent risk. What's inherent risk? Certain accounts, certain transactions are inherent by their nature. They're complex. They're subject to judgment. If you have more of those, you have a high inherent risk. If you have simple transaction, you have low. If you're in between, medium. Who determines the inherent risk? The auditor. The auditor assesses. That's all what they can do. They can assign a number to that. Then we have control risk, the risk that the company's internal control fail to detect or prevent errors. Also, this control risk is assessed as low, medium, or high. Low control risk means you have strong internal control. Your internal control are good. They are protecting the system, the financial system, from misstatement. High, it means no good. You have lousy internal control. And from the prior session, we looked at this scale and we said the higher your RMM, the higher your inherent risk and control risk. Those two are the RMM. The RMM, what you assess. The higher you assess them, it means the lousier they are, the lower is the detection risk. It means you are not the risk that the auditor failed to detect. You are not taking a chance. The lower is this detection risk. Now, let's look at each risk separately, starting with the acceptable audit risk. Again, this one is set by the auditor. Acceptable risk reflect the auditor's willingness, how much the auditor is willing to accept the risk that the material misstatement remain undetected in the financial statements after the audit is completed. So what's the chance we are going to take that after we finish the audit, we might still not detect certain things? You have to set this because you are going to miss certain things, but how much are you willing to accept a chance of missing that? Okay? This risk depends on what? On the importance of the financial statements to users. Now, what does that mean? If the financial statements are being used by a wide range of people, take, for example, publicly traded company. If you're auditing publicly traded company, well, you want to set this audit risk low. Why? Because many people are using the financial statements. So if you make a mistake, you're going to have a lot of people coming after you. So if you missed something, you're at risk of being sued. Therefore, you set it low. The opposite is true. If you're auditing a private company, you know the owner, he or she is the only person that's going to get this report, you have less users. The client industry. Certain industries are more complex than other industries. For example, if you're auditing cryptocurrency exchanges, that's risky. You're dealing with management. How's the integrity of the management? If the management has integrity, you have more confidence in the financial statement. Therefore, you would set it a little bit higher. You can take more risk. And the auditor's professional judgment. At the end of the day, you have to set this, how much risk you want to take. How much risk you want to take. Now, key point to remember. If you set it low, if you set a lower acceptable audit risk, if you set this audit risk low, increase the need of evidence. Simply put, if AR is low, you need more evidence. And basically, I hope this makes sense. It means if you're not willing to accept a chance of missing something, collect more evidence. Obviously, a higher acceptable audit risk is usually reserved for less critical engagement, but if you set it higher, you can have less evidence. Now, every time I show a relationship without saying the opposite is true, if you're willing to take more audit risk, then you collect less evidence. For example, a public company under regulatory scrutiny will have a lower acceptable audit risk compared to a small private company. And this is what I just said earlier. Auditor will perform detailed substantive procedures and may use advanced analytics for public company to ensure accuracy. So if you're auditing a public company, you want to set this audit risk, everything else is equal, because you have more users than a private company, well, you have to be more careful. Therefore, you will set audit risk low, you will need more evidence. So if the question is asked, what's the relationship between audit risk and evidence? They have an inverse relationship. Audit risk down, more evidence you need. Let's now take a look at the inherent risk. Inherent risk is right here. And remember, inherent risk, it's going to be part of RMM. And the reason I did this is to make it easier for you, because once you know inherent risk, you would know the relationship with the control risk as well. What's inherent risk is the likelihood of material misstatement occurring due to the nature of the entity, its environment, or specific transaction before considering internal control. Just the transaction, the account balance, the company by itself, inherently risky. There is nothing we can do. We have to live with it. We assess that risk. What could influence that? And we have a whole session: industry practices, the complexity of the transaction, and the susceptibility of account to fraud all contribute to inherent risk. What do you need to remember when it comes to inherent risk? Higher inherent risk, if you have higher inherent risk, okay, require lower detection risk. Notice, and we talked about this when we looked at the inherent risk separately, higher RMM, lower detection risk. It means when you have lower detection risk, it means you have to do more evidence. So if the question is asked about the relationship between inherent risk and audit evidence, the higher the risk, the more evidence you have to collect. However, if you are being asked about inherent risk and detection risk, or RMM and detection risk, they have the inverse relationship. When detection risk goes up, when RMM goes up, it means you have lousy inherent risk. It means the company is inherently risky due to its type of transaction and account balances. It goes down. Inherent risk is usually higher in industries with subjective estimate. This is what really makes it riskier. It's the estimates. Real estate valuation or biotech R&D will make RMM higher, detection risk low, evidence is up. For example, pharmaceutical company revenue recognition for milestone payment tied to drug development is inherently risky due to judgment and estimation. An auditor may need to review contract, corroborate milestone, and consult with specialists to gather evidence in order to determine how much revenue you need to recognize for this company. Therefore, you would need to collect more evidence. It means detection risk is down. You need more evidence. Well, control risk. Again, control risk, I made it easy for you, as part of RMM. Same concept. Control risk arises when the organization internal control fail to prevent to detect material misstatement. If you have weak or non-existing control, you increase the likelihood of undetected errors. So if this is bad, if you have high RMM, high control risk, what's going to happen? Your detection risk will go down. It means you have to collect more evidence, because you cannot rely on the internal control that's embedded within the company. You have to do the work as the auditor. Key points to remember: control risk and detection risk have an inverse relationship. We already know this from the inherent, because inherent and control risk, they go hand in hand. That's why I have them the same color. They're called RMM. Risk of material misstatement. Weak controls, which is high risk, high control risk, necessitate more substantive testing, more evidence. Low detection risk, it means more evidence. Or we can say higher control risk, the more evidence if you want to know the relationship. For example, a manufacturing company with the manual inventory system has a high control risk. Why? Because the inventory system is manual, susceptible to errors. auditor will likely perform extensive physical inventory count, reconcile discrepancies, and test purchase orders to ensure inventory accuracy. Why? Because it's a manual system. There's a lot of places where things could go wrong. So this is what we mean by control risk and evidence. More control, high control risk, more evidence. And RMM and detection risk are inversely related. Now let's talk about detection risk and evidence. Detection risk refers to the possibility that the audit procedures fail to detect a material misstatement in the financial statement. What's the risk of not detecting? This is the detection risk. You're not detecting the misstatement. Unlike other risks, detection risk is under the auditor's control and adjusted based on the level of inherent risk and control risk. Well, it's based on that. And we already know the relationship. If we have more inherent risk and control risk, we have to lower this risk. And to lower this risk, what do we need to do? We need to collect more evidence. So to lower this risk, we need more evidence. Now, if the opposite is true, let me show you this. If we lower the RMM, detection risk will go up. If detection risk is up, we need less evidence. So the relationship between detection risk and evidence, they are inverse. The relationship between RMM and detection risk are also inverse. Key point to remember, detection risk is inversely related to inherent risk and control risk. If the company don't have good control, if the company is risky company, inherently risky, you have to lower your detection risk. You cannot take any chances of missing anything. You cannot take that chance. Therefore, you do more work. High detection risk permit auditor to rely on less evidence. Why? Because your controls are good and the company is not inherently risky. Lower detection risk require auditor to gather more evidence and perform more rigorous procedures. All fits together. For example, a retail company with a straightforward revenue recognition policy and a history of clean audit will have low inherent risk, low control risk. If they do that, then the auditor may perform basic sampling procedures to confirm revenue transaction, resulting in higher detection risk, reducing the audit work. So if you have good control, good inherent risk, low inherent risk, then the auditor can rely on those, have a higher detection risk, collect less evidence, and the opposite is true. Now, let me show you kind of few sample companies, just kind of get you like a feeling on how to do this. So we're going to be working, I'm going to look at 3 samples, and 4 and 5 you could read it on your own. So let's assume we're looking at a local utility company. And here's what you are giving about this company. It has a stable operation, straightforward revenue recognition, strong control, and minimal evidence needed. Okay. Let's start with acceptable audit risk. What do you think the acceptable audit risk? Would it be high or low? I would say for this description, it's a stable operation, revenue recognition, it's not complex, it's a straightforward, and we have a strong control, and we don't need a lot of evidence. I would say we are willing to accept more risk, high risk. Why? Because the company is stable. Now, when we looked at stable operation and straightforward revenue recognition, I would say inherent risk is low because they're telling you it's a stable operation and revenue recognition. That's usually one of the most important account. It's not difficult. Maybe they receive everything through credit card. The transaction of sales is pretty stable. Utility companies, they bill the customers, they read the meter, and they collect the money. So revenue is pretty straightforward. Therefore, we have low inherent risk, and they're telling us we have strong control. It means we have low control risk. So now if we have low inherent risk, low control risk, what happened to the detection risk? There's an inverse relationship. High, it means we can take more of a chance. Well, if that's the case, how much evidence do we need? We need low evidence. So this is how we completed this. Let's look at this nonprofit company. Let's look at the fact pattern. Simple transaction, strong control, but low audit risk due to the reliance on financial statements by donors. So here we have a nonprofit. It could be also a private company for that matter. They have strong control, simple transaction, but the financial statements are being used by a lot of people, a lot of various groups. They rely on that. Well, if that's the case, I have to set low audit risk because many people, I have to set low acceptable risk because many people are relying on the statement. Simple transaction means I have low inherent risk. Strong control means I have control risk that's low. Now, Plan detection risk, also inherent and control are low. I may set this as medium. This becomes a judgment. Okay? Why? Because I want to do a little bit more work than company one because of the low acceptable risk. Now I could also go high, just like this one, but this becomes a judgment. So bear in mind, those are judgment. It's not like scientific. This becomes a judgment. So why is this low, and this is medium? Why this is low, and this is high? Because of the acceptable risk. Here we have more people looking at the financial statements. Then the evidence required, I would say medium. Medium. You would say, well, I want to do more work. If you want to collect more evidence, that's fine. You can collect to be safe. Or you could say, I'm pretty comfortable with this nonprofit. I've been auditing for the past 5 years. I'm comfortable with what they do. I know management. It has integrity, so on and so forth, and put this as low. But again, this is a judgment. Let's take a look at the third scenario. Cryptocurrency exchange, complex transaction, weak control. This reminds me of SPF, right? And regulatory public reliance, extensive evidence required. Regulatory and public reliance means the government and the public are relying on you. How do you set acceptable risk? Low. You don't want to take any chances. Complex transaction, inherent risk high. Weak control, oh boy, this is for sure SPF. High as well. Detection risk, if this is high and this is high, what happened to detection risk? It becomes low. If the detection risk is low, do we need more or less evidence? Way more evidence, high evidence. So this is how we would use this. Now, we can look at 4 and 5, kind of a medium type of situation. You could read them and kind of get an idea. Once again, this is a judgment. Notice here it's all medium. Okay? Here we have low, medium, high. So it's a combination. The auditor will have to justify what position they can do. Now, how do auditors respond? And when we have a risky situation? Well, if that's the case, based on the risk assessment, they will adjust the procedures. As we mentioned, they increase the sample size, extend testing period, use more reliable data. And we'll talk about those a little bit more in details. Simply put, they do more work. They assign staff that's experienced. Complex or high-risk audit often require senior auditor with specialized expertise. And adding layers of review. You want the work of the staff to be reviewed by the seniors, and the work of the seniors reviewed by managers, then the work is reviewed by the partner, including independent quality checks for risky engagement. Let's take a look at this multiple choice question by farhatlectures.com. In which scenario would an auditor collect the least amount of evidence? So you're giving 4 scenarios based on what we know. Based on what we learned, in which scenario we collect the least amount of evidence? When do we collect least amount of evidence? When we have low inherent risk, low control risk, less reliance on the financial statement by the public. Let's take a look at what we see here. A public company with strong internal control. Well, that's good, but that's not by itself. We still have to look at inherent risk. We still have to look at other factors. So A, you can't say anything about A. B, a small private real estate. Well, sorry, I apologize. Yes, they have a strong internal control. That's the positive. That's the good thing. But a public company, that's going to require more evidence because it's a public. A small private real estate company with minimal external reliance on financial statement. Well, B will trump A because this is a small private company versus a public company. A public company would require more evidence than a small private. C, a nonprofit organization relying on grants and donations. If you're relying on people giving you money on external parties, again, you're like a public company. Between A, B, and C, I would keep B. A pharmaceutical company with complex accounting estimate. Oh boy, I don't like this. If I have complex accounting estimates, I'm going to have to do more work. I have to collect more evidence. Between A, B, C, and D, I would keep B, and I would eliminate A. Therefore, the answer will be B, because it's a small private real estate company with minimal external reliance on financial statements. Maybe it's the owner wants to have the audit. That's fine. You're dealing with one person. You know, it's much easier than dealing with the public at large or a larger group or regulatory bodies like the SEC or state regulatory bodies. So the answer is B. What should you do now? You want to do more multiple choice questions. Go to Farhat Lectures. Whether you are studying for your CPA, taking accounting courses, Farhat Lectures is always here to help. Always invest in yourself and stay safe.